Imagine a world where dreams were built on pixels, where fortunes were made overnight, and the future felt limitless. It was the turn of the millennium, the internet was exploding, and anyone with a .com in their name seemed destined for untold riches. But then, almost as quickly as it began, the dream shattered. Trillions of dollars, entire companies, and countless life savings vanished in what felt like an instant. This is the story of the .com bubble, a modern-day gold rush that became one of history's most devastating financial collapses. The year was 1995. The World Wide Web, launched just years prior, was opening up a universe of possibilities. Suddenly, every business wanted to be online, and investors were gripped by an overwhelming optimism. This wasn't just a new technology, it was a new economy. Companies like Netscape, a browser pioneer, went public, sparking a frenzy. People believed the internet would change everything, and they weren't wrong. But their belief in how that change would translate to immediate profits and how much those profits were worth was wildly, dangerously wrong. From 1995 to early 2000, the Nasdaq Composite Index, a barometer for tech stocks, soared by an astonishing 600%. It was a dizzying ascent. Startups, often with little more than a catchy name and a website, found themselves flush with cash. Venture capitalists poured a staggering $112.3 billion into these ventures by 2000. Going public through an IPO, even without a single dollar of profit or material revenue, became the norm. Remember the Globe.com? Its 1998 IPO saw shares jump an incredible 606% on the first day. This was a time where a growth over profits mentality reigned supreme. Companies spent lavishly, believing market share, or eyeballs as they called website visitors, was the only metric that mattered. During Super Bowl 34 in January 2000, 12 out of 61 ads were from .com companies, many of which would be gone within months. It was an era of unprecedented exuberance, built on the promise of tomorrow, not the reality of today. So how did this happen? This wasn't a single fraud, but a systemic distortion fueled by what former Federal Reserve Chair Alan Greenspan famously called irrational exuberance. Investors, both big and small, were buying stocks not because of a company's sound financials, but because they expected prices to keep rising forever. Traditional valuation metrics, like price-to-earnings ratios, were tossed aside. Some .coms had P/E ratios of 200, meaning it would take 2 centuries of current earnings to justify their stock price. This was like building a skyscraper on sand, fueled by pure speculation. Companies rapidly burned through capital with unsustainable spending on marketing and perks, all in the race for eyeballs. It was a feedback loop. Venture capital funded unproven ideas. Easy IPOs brought them a market. Media hyped their potential. And individual investors, caught in the get-rich-quick frenzy, piled in, inflating values far beyond any rational measure. The market became a game of hot potato, hoping someone else would pay even more. But even amidst the euphoria, cracks began to show. Savvy investors started to notice that many of these businesses lacked viable models. They were burning through cash at an alarming rate, with no clear path to profitability. Meanwhile, the Federal Reserve, concerned about an overheating economy, began raising interest rates multiple times in the spring of 2000. This made borrowing more expensive and cooled off some of the speculative fervor. The cost of money was rising, and the party, built on cheap capital, was about to get a lot more expensive. It was a subtle shift at first, but for those paying attention, the storm clouds were gathering on the horizon. The storm hit on March 10, 2000. The Nasdaq Composite Index reached its all-time high of 5,048.62. Just 3 days later, news of Japan entering a recession triggered a global sell-off, disproportionately hitting tech stocks. The dominoes began to fall. On March 20th, Barron's magazine published a scathing article titled "Burning Up," exposing how quickly many .coms were depleting their funds. That same day, MicroStrategy, a high-flying software company, announced a revenue restatement, causing its stock to plunge by $140 per share, a 62% drop in a single day. Panic spread. On April 14, 2000, the Nasdaq fell 9% in one day, ending a week with a staggering 25% decline. The bubble hadn't just burst, it had imploded. The wreckage was immense. By October 2002, an estimated $5 trillion in market capitalization had been wiped out. The Nasdaq Composite ultimately fell a brutal 78% from its peak. Countless dot-com companies, once heralded as the future, failed entirely. Pets.com, famous for its sock puppet mascot, went out of business just 9 months after its IPO, plummeting from over $300 million to zero. BOO.com, a fashion retailer, burned through $135 million in venture capital in just 18 months before collapsing. Even giants weren't immune. Cisco Systems lost 80% of its value, and Amazon.com saw its stock fall by 90% between 1999 and 2001. Ordinary investors, who had poured their life savings into the promise of easy money, suffered devastating losses. Employees, who had been paper millionaires on stock options, watched their fortunes evaporate. Massive layoffs swept through the technology sector, contributing to an economic recession in 2001. The subsequent accounting scandals of Enron and WorldCom further eroded public trust, revealing deeper corporate rot beneath the surface. While the internet itself proved to be transformative, the dream of instant riches built on flimsy business models was a mirage. It taught us that even in the face of revolutionary technology, the basic rules of valuation and profitability still apply. The internet survived, evolved, and thrived, but the ghost of the dot-com bust serves as a timeless warning. When the promise of easy money becomes too loud, it's often a signal that the real cost is about to be paid. The question isn't whether bubbles will form again, but whether we'll remember the lessons of the past.